Good evening, everyone.
Good evening.
Good evening.
Hi. Apologies. We have some absenteeisms tonight, so I think we should get started. I got some emails. Anyone had a chance to read Module 7? Yes, no?
Yes, ma'am.
Oh, good, wonderful. Okay, so let's get started. So this chapter is on understanding the mortgage process. And of course, you already know that they say that the mortgage is one of the most important investments. But don't remember, we had that conversation when we said it is either a mortgage or rental. And the client has to decide which one is the best one for them in the long run, knowing that a mortgage is 25 years. So yes, it is a good investment, but of course, there's a lot that you have to put into in order to maintain it based upon the obligations in the actual mortgage deed that you have to adhere to. So let's move into the equity contribution requirements and interest rate. So we know that the interest rate that is offered to clients is based on the discount rate, the prime rate. So you know that the discount rate itself is at 4%. And the commercial banks agreed in 2017, actually on the 5th of January, they agreed that their prime interest rate will be 4.25%. So if we go around the room, you'll notice that I think it was 4 years ago when Scotia introduced their 3% mortgage rate. Can you explain why they would have done that? Nobody knows why?
No, ma'am.
No? What's the interest rate now for mortgages? I checked the websites and none of them actually give you the rates. And I know the rates are based upon, well, no, Thingham did. Scotia still gives their rate at 4.85% for
Yes,
mortgages. But they took a competitive advantage by lowering their rate to 3%. So no one knows why they did that. Don't forget now.
Maybe
Go
they
ahead.
had a lot of they probably had a lot of cash flow and they needed to invest some of that. So they did that to encourage persons to come to them so that they could utilize it in that way.
Yes, yes, yes. And plus it gave them a competitive advantage. Because don't forget, a lot of it was switch mortgages. So they took mortgages from their competitors and put it on their books. Because at the same time, they were doing restructuring of loans that they wanted to get off their books. So they wanted to more or less like swap out the quality of the loans that they had on their books. So most lenders require a deposit or contribution of 5 to 20%. And sometimes it is a little bit higher. It depends on the client. And for commercial loans, it's 25 to 30%. Again, it depends on the client because those are not hard and fast. Anyone know of any bank that offers a higher deposit or contribution for a mortgage, higher than 20%? Because I know it depends on the client.
for foreign clients, yeah. If it's
But for-
residential for foreign clients.
And what about local?
Local 20% appears to be the maximum.
Yeah, it appears so. Because I see this is, which bank is this? Bank of the Bahamas is 20%.
Yeah, they're running a campaign now 10 or 15.
Yeah, and I see they have years to repay. It's at 35 years. That is long.
No, it's 30 max and dependent upon um, retirement age.
Oh, so why the website has 35?
Can you tell me?
Oh,
I brought that to their attention on numerous occasions.
I don't know of mortgages being 35.
No.
No, they're normally 20 to 25 and that's it. That is very long. I wouldn't even want to keep mortgages on my books that long.
Well, Ms. Archer, that's what you have to do now to get the customers.
To put it to 35 years?
No, now I don't know about 35, but 30 is seeming to be a regular thing. I don't like to extend persons coming in the first time for that long, but for a lot of people to qualify, you have to go to the max.
Yeah, but I mean, if you look at it financially, you're tying these people down for a very long time.
Understood, but if you want to be able to assist them, that's what you have to do.
Oh, I see. You tie them in for a long period of time. The payments are lower, but they are just, I guess, that's it for the rest of their life.
Yeah, if you want the assistance, unfortunately, that's what you have to do because a lot of persons aren't qualifying. The income isn't sufficient to qualify for a 25-year mortgage.
Yeah.
It's always in the client's best interest anyway to take the longer term because they can pay, if they can see their way fit at some later point in time to pay more, they can do that and still shorten the term on their own by making additional payments or payments to principal.
Agreed.
Mm-hmm. But I'm going to add in here right now because I was going to talk about it later down. The impact of the credit bureau on all of this.
Oh,
Yes, that is something that I want to talk about tonight.
that's going to be rather interesting.
Yeah, I don't call it interesting. I don't call it interesting. It's a discussion we're going to have tonight. So we can leave it for later or we can talk about it now. Tell me, how is that going to work?
I missed out on that whole piece of conversation that y'all just had. I hear a word.
What happened? We were talking about. Okay.
I don't know. My internet is in and out, man. The weather is awful in Freeport.
Okay, we were talking about equity contribution for mortgages. And I was saying to the class that I did my research and I noticed that Bank of the Bahamas offers 20% contribution, but the years to repay is 35 years. And I was asking, one, why would Bank of the Bahamas extend it so far out? And two, why would anyone want that? To help these persons to qualify for the mortgages. That is very long.
That is too long. That goes beyond some people retirement and all.
Yeah, she says, no. She said it was, he said, or retirement age. I mean, for the life of me, you actually putting these people up for failure.
Yeah, so true.
I mean, okay, it's not okay. The bank is in the business of making money, okay. I agree to that. But if you actually given sound financial advice in this process, I don't understand. I don't understand. Because even sometimes when you stretch it so far for these persons to qualify, then the question is the same thing we discussed the last class. Can they maintain it? because they have an obligation to do so.
That is the question right there. Can they maintain it?
Right. So I'm right. Go ahead.
That's a very long time for a mortgage.
Yes. And you're talking about 35 years. So let's just say they are newlyweds. In 35 years, they will have children. Those children will leave, go to university. Those children will have grandchildren. They're still paying mortgage on the same house.
Yes, they are. That's a very long time.
I don't understand the logic behind it. That's too long. Because you're going to be saddled with a lot of loans. Maybe delinquency after 20 years. Because it's just too long. Okay, so who can tell me about the credit bureau? The last report was in August to the public, where they said that they're still in the beginning phase or process, but they are moving with expediency. As everyone is sending in the information in order to get the credit rating. So my question to you now, for those who are bankers, what happens when the credit bureau is ready to go, and you request reports on all of your existing clients, and they don't have good credit rating? What's gonna happen?
Existing, I would assume nothing. If it's on the books, there's nothing that you can do about it.
I don't know, but is that a wise decision to make? Do nothing?
What can they do? It's on the books.
I think that's something they're gonna have to think about.
But then too, Ms. Archer, why would the Bahamas government or central bank, why would they start a credit bureau in this day and time when Bahamians have been 60%, some over the DSA for numerous amounts of years? Okay, how are you now supposed to get customer DSA to 45% when central bank has allowed you to do a DSA at 60% for umpteen amount of years? Now they have, the pressure is on. The credit bureaus in place. We need these people's DSA to be 45%. How are you now supposed to get these members or your customers DSA down to 45% when it's been in such an arrears for so many years? The only thing you're doing right now is lying. In all actuality. Yeah, and Bahamians, a lot of Bahamians, Ms. Archer, believe it or not, are not aware that the credit bureau is even in effect.
Really? Even
they are not aware. Believe it or not.
But even banks have sensitized the public. They've done it, you know.
But a lot of Bahamians are still not aware. A lot of Bahamians still don't believe that it exists until they come and get a loan. And then you tell them, I have to credit rate you. And they're like, what? What is that?
Oh, well, that means that the banks do more informational sessions.
Yes, they do. Bahamians are not aware.
Yeah, because this is
Oh, come on, internet.
so the credit bureau itself has been on the table for discussions from the time I worked there. This is nothing new. This has been on the table for over 10 years. Nothing new. All of the banks are, yes, the central bank would have been lenient in terms of debt servicing ratio during certain times in our life cycle as a country. Hurricane disasters and stuff like that, they would give some kind of leniency, but it was the bankers themselves were always told that this is coming. Be mindful of it. It took a long while for them to get the legislation right, and they sent it out to all of the commercial banks for their comments, their review, and after that, they tried to find the firm that would actually help them along with the commercial banks to put that infrastructure in place, because it takes quite a while. One of the issues we have besides our domestic credit rating is internationally. Don't forget, we have a lot of persons that do business internationally, and they have been asking why we don't have a credit rating for our operations in the Bahamas. So it's twofold. One is for domestic, and the other one is for the ease of doing business. And so this isn't something that the central bank just came out of a hat. Remember, we are always being reviewed by the IMF. And when they see gaps and deficiencies, they're going to make recommendations. And they're not going to keep making the same recommendation over and over again. The country has to start to put measures in place to address it. So the first set of reports should have already gone out to the commercial banks based upon the information that they have so far. So, and when the governor reported in what when that was, he reported at the beginning of this year. He opened by saying about 30% of the Bahamian borrowers will struggle to obtain loans once the credit bureau is up and running. No, he didn't say that. Tingham said that. Kendrick Brathwaite. And that's B.O.B.
Yes, ma'am.
Okay, so he made that statement. He said close to 1/3 will find their ability to access new credit is curtailed because of past failures to disclose existing debts will come back to haunt them.
And that's exactly what's happening now.
Yeah, okay, and the credit bureau. So I don't understand why Bahamas are not aware, because it has been in the past.
Because the name is so read, Ms. Archer.
Oh, Lord, but they need to. So it's,
A lot of people listen to the news because they only listen for what they want to hear.
yeah,
They read the paper and they only read what they want to see.
yeah. So he says, what else they say? They say alerting Bahamians that they will no longer be able to bounce from one bank to the next, hiding histories of missed payments as they go. Mr. Brathwaite said the credit bureau would enable the industry to escape, in quote, operating in dangerous waters, where it does not possess a complete picture of the loan applicant's creditworthiness. And that's why I'm saying once you get the credit report on your existing clients, it may be painting a different picture. And it's something that you have to be prepared for, because don't forget, mortgage is long-term. There's more possibility of more, not just defaults, but a lot of people who no longer qualify for the mortgages that they have. Mm-hmm. So that's something else that you have to think about in this area of mortgages. And so the information that's going into the credit bureau will come from the commercial banks, insurance companies, credit unions, financial and corporate service providers, Bahamas Mortgage Corp, Bahamas Development Bank. Once they have them from all of those, then they'll move into the utilities companies, the auto dealers, and the furniture stores. And even the government revenue agencies. So that'll be VAT and real property tax, business license. They'll put all of that together on your credit rating. Any comments? Y'all going quiet.
I have a question. Good evening,
ahead.
everyone. I want for the other person. I want to know if they do something that they call a credit score.
No? Yes?
Hello.
Hello.
Hi. No, I want to ask the other person in the classes if they, when they do a loan application, if they do something called a credit score.
Yes, the credit union does a credit score.
Okay.
Yes, ma'am.
All right, just checking, and I know with us, we do a credit score, and then on a part of our application, we have something about the brewer and the scoring and all of that. So in all actuality, I think the bank itself, we know that it's coming, but like you say, if you're informing the public of it.
Mm-hmm. Yeah. Because they're saying the flip side of business, that persons that have good ratings will be able to borrow more money. So they're saying that those kind of people will love it. Then now they have a credit rating. They know just how much they can borrow and they won't have that much difficulty. But the thing is now is that those that will not have a good rating, after you've compiled all of this information together to really see how thinly stretched they are, it's going to make a difference. It's going to make a big difference.
It's making a difference now, actually, because even doing loans, because a lot of companies now are hesitating to do salary deductions for their workers. And then a lot of companies now are putting their deductions on their pay slip. So you're actually seeing how many loans or how many loans they have with other companies, with other banks. And you do their credit rating or their credit score, and you do their DSA, and a lot of them, I'm like, 4 loans, and you ask like, how you get these other 2 ones? You actually couldn't apply, you couldn't get these loans. How did it happen?
Yeah, exactly. And so they stretching every month to pay these so that they don't enter into default.
Yes.
Yeah.
And you have
So
a lot of customers that can't even apply for a loan right now.
Mm-hmm.
Yeah, they're coming, but they can't even get a loan as simple as a little $2,000 loan. They just can't get it.
Yeah, and that's why now it's time for the. How do you encourage them to save?
Well, with our loans, each time we do a loan, we put a savings in the salary deduction that we get from them. So they pay rent and they save at the same time, even if it's only $25.
Something. It's something.
Yes, but that mandatory $25, you cannot touch that until your loan is completed.
Mm.
All of those funds that's there. So at
And-
least when your loan is paid, at least you will have something to say that you have the savings.
Can they apply it at the end towards the mortgage?
Yes, they can.
Okay.
Yes, they can.
Yeah. So for those who haven't read legislation, You need to take the time to read it because it is coming. It's 42 pages long. And you need to read it. So you could notice now that the prime rate is at 4.25%. And that's the lowest rate of interest that is charged on loans in the private sector. So until the central bank reduces again its prime rate, it remains at 40 basis point plus the 0.25. And you can see how much it has decreased from 1993 to now. Before 1993, this rate was almost up to 10%. But we're down now because, of course, there's a lot of liquidity in the system. So now let's look at the mortgage process. There are 4 steps: loan origination, loan underwriting, loan administration, and of course, loan servicing. Turn to the next page, we have the diagram. So origination. This is sales oriented. Initial client contact, KYC issues, complete and submit credit application, and client servicing. Now I went on the website, I noticed that FCIB has a very good loan calculator. It's very detailed. Anyone ever saw this financial health check monthly budget worksheet? It has your income, my pay, my partner's pay, other income, and then it goes down and asks you to put in your home bills and utilities, your auto transport, food and dining, family and personal care, entertainment and shopping. And then it asks, do you have any monthly loans we haven't covered yet? Any monthly expenses to add? Any expenses you like the checklist annually? And do you transfer any of your take-home pay to other accounts? And then it actually does a calculation. It's quite detailed. But this is the critical stage right here now, coming where the credit bureau will play an important part as to whether or not a client actually can be, I guess, entertained with an application for a mortgage. The next step is underwriting. And of course, that's the credit risk control, looking at the market assessment, credit adjudication, and then administration. And administration is looking at the operational risk process, the credit disbursement, and the collateral adequacy. And of course, servicing, again, looking at the risk. So the following points below summarize the mortgage process. The first is the application. The lender normally requests certain personal and financial information from the prospective borrower in order to make an assessment of his financial viability. So, at this stage now, this is where the credit bureau will come in. So you look at the personal information, the address, the dependents, the type of residency, the employment history. Then you look at credit and debt history. I wanted to ask you all, I noticed that in terms of employment history and then salary, a lot of these young persons are moving from job to job every 12 months to 18 months. How do you factor that risk in terms of payment with them constantly moving around?
It's actually with us, if they move to the same field, we would look at that as continued employment because they're going into the same field.
Okay.
Like for example, like say if a lawyer was to McKinney Banker, and then he moved to Pembroke Williams, so we would not see a break in employment.
Yeah, I could see that one. but I know a lot of the young people are moving. If they are in employment now, but they're moving, just for salary increase to qualify for mortgages. And I don't know how long they can sustain that because they just keep moving and moving and moving. As they can get 5,000 more, they're gone, 10,000 more, they're gone, 15,000 more, they're gone. And they just keep looking and looking and looking to get a higher and higher salary. So this part about getting the credit and debt history, the credit bureau will take care of that. So you don't have to worry no more if they're telling you a story. Because it's expected that the credit bureau will give you accurate information. Then of course, there's the appraisal of the property to be mortgaged, and it should be assessed by a qualified appraiser. And any other information that may be necessary to assess the borrower's viability to qualify for the loan, including his financial ability. Now, my question is this: when you have someone who is divorced, do you find out whether or not they have a court order to pay alimony and child support?
No, ma'am.
So that's why you see a lot of times these persons cannot pay because they have other commitments that they have to pay before they even pay mortgages. So that's something that you need to consider also. Because when you get these credit reports, you may be surprised at what you see. So based upon the required information that you have received, then you would assess the same along with the completed application form to determine the borrower's suitability. And the decision is made by the credit underwriting manager who is attached to the branch originating the application. Of course, that depends on the structure of the organization. If the mortgage loan is approved, a facility commitment letter is issued outlining the details of the mortgage, including the type of mortgage loan, amount of the mortgage, the collateral security to be held, interest rate, service fees, period of time for the mortgage, and repayment terms. Once it is accepted by the borrower, and accepted means it's executed, means that they sign the documents, instructions are then prepared to engage the borrower's attorney who will be handling the matter. So the next step is the engagement of the attorney. So upon receiving the lending institution instructions, the attorney will commence the process of ascertaining good and marketable title to the property being pledged to the lending institution. And remember, I told you all I think it was the second class, this where a lot of banks had issues with good and marketable title by the attorneys who were doing the work at that time. And the banks had to turn around and sue the attorneys because they didn't have, they had actually executed the mortgages were on the books, but the banks did not have good and marketable title. Anyone remember that? That wasn't that long ago. No?
I recall when I was the first Caribbean, I think it was in about, I think 2011, 2012, something like that. I know they took on a huge project related to mortgages that were on the books, where they had a lot of facilities that the bank did not have clear title for the properties they were holding liens over.
Exactly, it was a lot. And of course, it went to some of those attorneys being disbarred. Because some of them, the titles were not registered because they spent the monies. And they weren't able to, they couldn't afford to even use the monies that they had in order to complete the jobs. And I think in some instances, some banks still have some of those legacies still sitting there because they found out that they really don't have the title to the property. But that was another issue that had to be cleared up. So of course, a search is conducted of the mortgage property to ensure that the title is free and clear. Remember, fee simple, absolute in possession with no prior mortgages or other encumbrances. And of course, you know, once you do the search is one of the three, of the lesser of the three, in order to say you have a good title, going back at least 30 years, or a period extending further back than a grant or a lease from the Crown, or of course, a certificate of title granted from the court in accordance with the Quieting of Titles Act. You also have to look at the cost list, and they're normally published on the Supreme Court website, and you're looking to see if there's any matters relating to the property or any matters against the borrower that may affect the title of the property. Any enforcement actions. So once the borrower's attorney is satisfied that the title is good and marketable, after raising, of course, any requisitions, and remember that is any questions they have raised on the title of the property. Once they are satisfied, then an opinion on title is made by the attorney. The mortgage document is also executed at the attorney's office by the borrower. And where the borrowing involves the purchase of real estate, the conveyance from the owner to the borrower is also executed. And then, of course, the complete package is sent to the lending institution under a cover letter. So in addition to the mortgage document, the lending institution may require the borrower to execute a promissory note, which further stipulates the borrower's obligation to repay the loan. And this could be completed either at the attorney's office or at the lending institution. So my question to you is this: if I have my mortgage deed and I also have a promissory note, does the bank allow you to sell your promissory note? Not you yourself, but the bank. Does the bank sell promissory notes?
You mean the actual note itself, or the?
Yeah.
No, I don't think so, not to my knowledge.
Because I know in other. Anika, say?
I was going to say, I would assume only if you default, and after it's already, the bank has already gone through what it needs to go through to repossess the property and sell it.
Yeah, I know in some jurisdictions they would sell the note. So sell the note means that they don't want to be responsible for collecting the debt. They keep the title, but they have someone else to collect the debt. And of course, we know what selling the title is. So the promissory note is that same note that they signed to say they will pay X amount for whatever number of months or whatever period. In some jurisdictions, they actually sell the promissory note, especially if the company needs monies. It's an easier way to do it. Instead of doing it yourself, you actually have someone else purchase it from you and then give you the cash. And then they turn around and they start collecting the payments. It's a way to make money. So upon receipt of the completed package from the attorney, the lending institution will review the same and ensure that all the other terms and conditions contained in the approved application and facility commitment letter are compliant. Now, the completed package from the attorney should include the following: the opinion on title, confirming that it is a good and marketable title going back at least 30 years, or the lesser of the three. The original back title documents, certified copies, the original conveyance of property to borrower, a copy of the registry receipt, evidencing that the necessary documents, that is the mortgage and the conveyance, have been lodged for recording. The lending institution relies on the opinion of title.
Now the bank, Ms. Archer, the bank doesn't require that at that point anymore. The registry receipt,
Uh-huh.
they don't require that anymore. So once you receive the package, loan is booked, we would send them funds for registration, for registry and recording.
Mm-hmm.
Then once they provide that and the receipt, then we release their funds to them.
Oh,
Yeah, so the bank no longer requires them to, I guess, because they would have had to go out of pocket or go to the customer to get the funds to register the documents. And since the bank handles that portion of it, releasing the funds, we just, all they have to do is just send their unregistered document, mortgage document, copy of the conveyance, and then provide the registry receipt. Once we provided them the funds for the purchase and the funds necessary to have the documents registered.
oh, okay. Hmm. So you don't require even the original back title documents?
Yeah, they have to send those. So they're supposed to send those. If not the originals, like you say here, certified copies.
Okay.
So that's one of the ways I understand that they, one of the things they implemented to avoid that issue where you have attorneys not having documents registered, spending the money after you then send it to them.
Exactly.
And the bank left, basically holding the bag with documents that haven't been registered, titles that weren't clear, stuff like that. So they know that, okay, if you don't send the registry receipt, then you don't get your money.
Yes, yes. Mm-hmm. Yeah, I remember, because I remember when Scotia changed their process, because they did that. So it said, once it's satisfied that the collateral security for the loan is legally owned by the borrower, the lending institution books the loan by advancing the mortgage amount. And funds are usually dispersed via the borrower's attorney for the purchase of property, or otherwise, as the case may be, based upon the assurance made as per good title in the opinion. So after that, it's anticipated that the mortgage loan will be serviced satisfactorily for the duration of the stated term. So once the mortgagor has paid all sums that are due owing under the mortgage, the lending institution may at any time thereafter reconvey or reassign the mortgage premises to the mortgagor or as the mortgagor directs. And of course, the most common form of discharging is via a satisfaction of mortgage. And I'm gonna tell you now, when you take those documents to the registry, they tell you it takes a long time, months.
Yep.
Longer than 6 months. So a satisfaction of mortgage is a document generated and signed by a mortgage lender, acknowledging that the borrower has paid off the mortgage loan in full, and that the mortgage is not a lien on the property. And I'll tell you, go today to the registry and they tell you need these documents. Go day after tomorrow and they tell you, oh no, it's not that document, this document plus that document. But then you go and they tell you, oh, they missed out this clause in this form. I said, but these things are standard. I said, can't keep changing every day. And the last time I went, I said, you better take these documents as they are, because they're not being changed again. And I see there's a ball of confusion in there when you go. So the steps in the mortgage loan process: the initial interview, and then you have the borrower finds the property, execute agreement for sale, and obtains appraisal. A second interview, gathering information, having complete picture and complete application. Credit assessment and processing, verification, structuring, documenting terms, recommendation, and submission. Credit underwriting, that's a review and the decisions to be made. Then you have the client advising the client of the decision. Then you have the commitment letter and instructions to the attorney. And then, of course, the attorney's activity. Taking of the security, that includes the opinion of title, list of title documents, compliance with approval terms and conditions, documenting compliance and or non-compliance, booking the facility, monitoring and controlling, managing non-compliance, managing delinquency, reviewing, and then discharging and satisfying the repaid mortgage. My question now is on monitoring and controlling. As a credit officer, how do you monitor and control? I know it's done by credit underwriting, but as a loan officer, how do you look at monitoring and controlling, or is all back office?
You're referring to ones that's already booked and on, it's already dispersed and on the books?
Yes.
Really and truly monitoring after that. Should I say ceases? Unless the loan defaults, there's really no reason to monitor the facility. I know every once in a while it's revisited, so you can, you're supposed to maintain some type of relationship with your clients. So once in a while, you're supposed to visit the clients on your portfolio just to, I guess, do a temperature check. But other than that, unless the loan defaults, there's really no reason for you to monitor it.
Monitoring and controlling. No, I just wondered why this was here, because I know that unless, of course, just like you were saying, unless a loan is in default, that means it comes on the radar of credit. No one, they just assume that you're paying. I don't understand the monitoring and controlling. That's why I asked if this was something that you would do, because I'm not aware of it. And managing delinquency and then reviewing. So I don't know much about that. Okay, so we're not too long tonight. Okay, let me ask you something about the credit bureau before you go, because I'm thinking of putting this on the exam. Don't say, oh Lord. First thing is this: the credit report, you're allowed to have one free one a year as a borrower. And of course, the charge is $12, not expensive. So if the report that you receive is not accurate, because as a borrower, you can look at it, or if the bank assumes that it's not correct, they can inform the credit bureau within 5 working days so that the information can be replaced or corrected by the bureau. Because what the bureau is saying is that they always have to be sure that the information that they have is always accurate. And another thing about it is that once the bank receives the information, a credit report, they cannot use it for any other purpose than to ascertain creditworthiness. institutions using the Bureau are responsible for keeping the client data secure when being accessed. So those whose credit reports are being accessed will need to familiarize themselves with how the credit bureau works and how to ensure that their scores are acceptable. And of course, the public has to understand how to be more familiar with how the credit bureau works and how their data are processed. So it's a twofold learning edge. One is for the banks themselves and another one is for the borrowers. So one of the things, the consequences of the whole credit bureau is that people have to begin to understand or be aware of their credit issues. So they start to take care of the data that's in the credit bureau. And I think what they're gonna have to understand is what moves your credit score. Because you know, in other jurisdiction is not just based on delinquency, it's even based upon how you make your payments and when you make your payments. And I noticed they haven't discussed that yet in any of their reporting as to how the credit rating will actually calculate. They haven't gotten to that stage yet to explain that to the public. But in other jurisdiction, it depends on when you make your payments. And your credit rating could just drop overnight because you missed a payment. I noticed too in Canada, your credit ratings can drop if you don't use your credit facility.
Correct.
So that part of it, they haven't explained us yet as to how it is calculated and what you have to do to maintain your credit score within a particular bracket. So that's why they say they're only at the beginning stage now and just collating the information and just coming up with a rating. But all these other factors are going to have to come in as to how they come up with the best score ever. Any comments?
No, ma'am.
So you're ready for the credit bureau?
If you ain't ready, it's here.
It is. It
It
is.
is here.
Not the amount of loans I be seeing.
Yeah.
It is.
Yeah, but I realize you have to familiarize your clients with the concept that the credit bureau is operational. They're in the process of gathering information, and you have to be aware that you're going to have a credit score. So they have to be able to tell you what exactly they have borrowed, because it won't be a pretty picture afterwards.
Miss Archer, I could tell you that so much next time possible when you have a customer pay off Bank of the Bahamas this in July, go to Fidelity in August before the first payment make, pay off Bank of the pay off that one, then go to the next one before the payment come out for that the following one. It's crazy.
And that sound normal to you?
It's normal. Does it make sense? No, but it's normal.
No, but you can't do that. That's just bordering on fraud.
That's what they do.
That's bordering on fraud. You can't do that.
That's what they do. But that's what these institutions, that's what they encourage. Because when you give people these targets that they have to meet, it's like it's no more human involved in the process. It's like I've seen clients since I came to Bank of the Bahamas, and it really hurts my heart because like coming from First Caribbean, I'm not used to this type of lending. And I would have a customer come in literally this month. They just paid off somebody else in September, and they're in Bank of the Bahamas in October for Bank of the Bahamas to pay off that person who they just paid off
Mm-mm.
who just paid their loan off in September, and the first payment didn't even come out yet.
So what is that telling you?
We
They
in
need financial support.
They're in financial problems.
Yeah.
You
But
see,
they do that for true. Miss Archer, they do that.
that's
Not just
what
to
they
make the
do.
bank, they do that to credit unions.
They use the bank like it's a piggy bank.
No,
Yes,
but
I
I
agree totally.
hold on. I know the credit officers have these huge targets now because they always complain about the targets. If you can't meet the targets, of course they let you go. So everybody's trying to meet that target, but financially, it puts the borrower at a disadvantage because it will all stop. And I'm afraid that when the wheels stop, they will not be able to repay you all this money.
Well, that's where we headed.
So it's just like if you're in a boat and the boat is just drifting, but it's drifting towards what just call those things what is formed in the middle of the ocean with a hole in the middle.
Oh, the black hole,
Yeah,
like
that,
in the
yeah,
Bermuda.
that's where they're heading.
Yeah, and that's where we're headed. I know customers that have left jobs to stop deductions so they don't have to pay back the loans because they know the type of situation that they have dug themselves into.
Mm-hmm.
And these commercial banks, like I say, this is what they are encouraging right now. Bank of the Bahamas is lending government workers up to $60,000 unsecured. Fidelity,
What?
I think, is going up to 70. What is that?
Yeah,
What?
right. Even though they are liquid, they should not be doing that. No.
What is that? Oh
Oh
my
my
God.
God.
Mm-hmm.
What?
That's what the commercial banks are doing. Commonwealth Bank, I think, is 70 as well.
Oh no. Oh no. Mm-mm. I see losses coming.
Yeah.
And
What are they able to use the $60,000 or $70,000 for? Is this just like
No,
a
see,
personal loan?
you're not going to get this cash in hand. But the problem is where these persons have been bank jumping for so long, that's just how high these loan balances have been accumulating over time. And then if you go to a bank like Commonwealth Bank that does compound interest, when you walking away, they don't lose because they didn't add their interest in there. And these people don't come, customers don't come for you just to clean them up. No, every time they come, they want an extra 5,000, extra this, extra that. And so the numbers just keep rising until you at 60 and $70,000 in no time flat.
no, no.
That's banking, that's commercial lending in
But
the
you,
Bahamas
but
at
you,
this
do- but
time.
you do know that BOB was in issues before with the regulator for credit.
Well, like it's not just Bank of the Bahamas. I tell you, from I was the first Caribbean, this is what my experience was with Bank of the Bahamas customers, Commonwealth Bank customers, and Fidelity customers.
Oh, that's not good.
And being at Bank of the Bahamas now, I see it firsthand. First Caribbean, you walk through the door, you come in with them type of debt, unless you have something for them to hold, they tell you, see you later, we can't help you.
Mm. Oh, I see. Y'all giving away free money.
Free money, apparently.
That's free money. I don't understand.
I
That's
know a
the,
couple of years ago, Commonwealth Bank had that going on too, but they had a cap. They had like $20,000 to $30,000 for BOCO employees, shipyard employees, the airport. All you have to do is go inside and you got them cash in hand.
Yeah, and they were giving that.
Yeah, they were doing that. And people
with no
were actually
collateral.
going to get that. Now they come into you and want you to consolidate these loans that are so out of control. So
Exactly.
they are crying on your shoulder, yeah, because they're saying, oh, I'm paying every month and everything is just going to interest, nothing is going to principal. I mean, I've had these loans for 5, 6, 7 years, and the loan going up instead of going down.
Your cost is going up.
Yeah, it's crazy. It is
This is,
crazy. And especially after Commonwealth Bank had, I don't know, they had some kind of situation when the pandemic came on. They gave all of their loans a 6 month extension.
Yes,
And
ma'am.
yeah, and
And not
kind
even
of
an
man,
extension. You can't even call it an extension. They gave them back 6 months worth of payments.
because she was saying too that she said, Miss Simmons, I never signed up for it. She said, but when I found out about it and I checked with my loan officer, she said that it was an executive decision that was made in Nassau to give all loans and mortgages 6 months. I said, what? I said, you never signed up for access? She said, no.
hmm.
She said, my salary never stopped. I was never affected. My salary still was the same. My salary reduction was still going in the Commonwealth Bank. Nothing stopped and everything was the same, but they still gave me that 6 months
6
extension.
months. Mm.
Yeah.
But she can't over the counter, take it off
I
the
can't,
account
I
counter.
can't hear you.
Now I'm saying, can't she take off and make it as an over the counter? Yep. Right?
Yeah, you can do that. I told my sister to do that because they, like she said, they did it automatically. So they gave her back 6 months worth of payments, and I told her, you don't need it. Go and reapply it as a principal payment.
Yes. Yeah. Because you have to try to help these clients out in some way, because I'm telling you, when this bureau comes, there's going to be some real problems. And I can hear them all on the talk show trying to blame somebody for it.
Accept themselves.
Yes. It's already started.
Yeah. I haven't heard anything yet. What are they saying?
That client that I'm telling you about, she said to me, she said, Miss Simmons, I'm going to take that loan that I have, because she has two loans at Commonwealth Bank, a car loan and a personal loan. A car loan is like 22,000 and change. A personal loan is like 36,000 and change. She said, I'm going to take it. She said, Fidelity told me I could bring it to them and they'll solve my problem.
Oh,
Yeah. And she said she was going to that.
oh, this ain't good.
Because her thing is, soon she said, I need some money in my hand. And Fidelity told me that they could fix it. So I'm going to take it to them.
Yep.
Yeah,
So
but
that's what we're facing right now.
it's going to cost a run, it's going to cost a run on banks, because these banks going to be in problems. They're going to be in some serious problems. I don't see how it's going to work. And then these people owe so much money, and they're not holding any collateral. So what happens? Then they can start to put everybody in court. But if they can't pay, they can't pay. I don't understand it. I don't understand it. But that's something that y'all need to think about, because I don't know how it's going to work. Because with the credit bureau coming on stream, if you deny credit, right, to a borrower, you advise them that based on their credit scoring, you cannot offer them any facility. Then they could go to the credit bureau and ask for a copy of their report, which they can go through and review. So you can see the back and forth now. You can hear them saying, this is not true. Oh, this is not true. Oh, I paid this off.
Oh, yes, ma'am.
Okay. I
That's
can hear.
exactly what is going to happen.
Mm-hmm.
Yeah, that's exactly where the problem is gonna come in right there.
Yep.
Yeah, because that same client, she was saying that she pays her car insurance out of her pocket. She said she has receipts. The Commonwealth Bank is telling her that they just pay her car. They've been paying her car insurance for almost 4 years. So yeah, so she is now trying to figure out, so where did this money go to? Because my insurance people ain't never tell me that y'all paid my insurance.
That's
I'm paying
about,
my insurance and y'all paying my insurance.
but are they paying it to the same insurance company?
Yes, according to them. Because she say it's on her loan as insurance payment. She said when she saw it, she's like insurance payment.
But
She
that
said, I
can't,
asked someone, and they said to her that they just pay her car, they've been paying her car insurance for 4 years.
so if they were paying and she was paying, then the insurance company should have a credit.
Thank you. So it can't be to the insurance
Okay.
company that you receive a premium for one customer twice a year.
And
Oh.
I said the same thing to her.
For 5 years, that's not possible.
No.
Yeah.
She went to someone else for cheaper insurance premium and the original company. That's what happened there.
I said, yeah, you paying and Commonwealth Bank paying? I said, I said, God, but you know what it is too? You know what she said? She said when she got that loan, she said she barely goes into the bank, she barely checks because her salary deduction just comes out. And that's it. According to her, she knows that her payments are being made on time because BTC sends her money on a regular basis. It's deducted out of her pay because she can see it on her pay slip. So she really don't go into the bank and check her
Oh.
loans and see what's going on.
Okay.
Yeah. And she said she went in there because a friend of hers told her that she was having problems with Commonwealth Bank. She said, her friend told her, you better go and check and make sure because you're a person who don't check. When she went, she met a problem right there.
Yeah, but that don't sound truthful to me because even,
Yeah, when she said that to me, I said, how do I said I can be? I said, because if you have records and the bank have records, so then the insurance company should have payment for you then, or for the bank.
yeah,
That means that the insurance company taking money from you and the bank. I said that don't make
no,
sense.
no. And then the insurance company is audited every
Exactly.
yeah, that ain't right. She's sending her money somewhere. So she just
Unless one of those payments are going through under the wrong name.
well, that could be too, but I'm sure the bank put it to her name. I think it's a different insurance company. That's what I'm thinking. They're not sending it to the same one. That doesn't add up. For that, no.
Yeah, no.
No. Because when she would have gone to pay, then the insurance company should have said, but this is paid last year.
Exactly. We have a
Or
credit for you.
right. Or they'll say, last year the bank paid for this also. So we have a credit for you. So I don't understand.
Could
No.
it be that she neglected to pay at some point and then they just decided to go and sometimes a bank, if they realize you didn't pay for the insurance or something, they would go ahead and pay it?
Yes. And that means that every year company contacted them to pay the premium.
Yeah, I think that's what happened there.
And I think she still should credit or pay the bank, but I don't know. Because it was a supplier that own it. Now they can put. But that story don't sound.
Mm-hmm. It sounded sort of sketchy to me too, because I know the majority of the banks are and the insurance companies are mainly on the same page.
Mm-hmm.
I mean, we don't have no problem with the insurance companies that we deal with. When it's time to pay, they send a notice and we pay it, and then we send a copy to whoever it belongs to. We send them a copy and let them know it was paid and such on certain things we have in our agreement where if you can't pay, you come, you let us know, we do what we have to do, and you sign off, and that takes care of that.
Mm-hmm. But there's no,
Yeah, but for yes,
and no one contact. That does not. Mm-mm. Not at all. All right, so I'm gonna send you some documents to look at for next class. Let's see if I could find any other ones to go with it. So next class is about the practical administration of legal documents. I think that chapter is too, no, that one isn't too long. So I'm gonna send you some precedents for us to look at and discuss. I think. Yeah, I'll send you some. Hopefully I'll send it tonight because I'm going to start right now once we're out. All right, so have a good evening. Sorry for being late. I had to work late, so I'll try to be here for class on Wednesday so you all won't have to so late. Okay?
sometime late is good.
Sometime
Maybe
later.
that's the time.
Okay.
Good night, everyone.
Good night.
Bye.
Good night.
Okay, good night.